Hi guys, welcome to Jeff Weibo's channel. It seems Jeff's disappeared, I don't know. But you've got Mitt here from Galleon CPA, here to give you the top 5 tax tips. So let's start with tip number 1. As a real estate investor, you should always set up a separate bank account. The reason why you want to set up a separate bank account is so that you can track the rent and expenses separately. This allows you to go back and be able to review your numbers with ease. If you're using all the same bank account, it's going to get really difficult to dig through and figure out what expense and what income related to which property. So set up that separate bank account. I know here in Canada, BMO lets you open up about 20 for free. Now let's move on to tip number 2. Get yourself cloud storage. Nothing annoys an accountant than receiving a box full of receipts from their client and digging through. And what usually ends up happening is that you're gonna lose receipts or they're gonna wear out. And that means you get to lose expenses that you get to deduct. And that means you're gonna have to give the government more of your money. Instead, utilize a solution like Google Drive or Dropbox, where you can track your expenses by property, or utilize an app solution that we recommend for most clients is Expensify. You take a picture of it and you can allocate to an individual property. At the end of the year, you just export that report and provide it to your accountant. That brings me to tip number 3. You gotta utilize an accounting software like QuickBooks or Xero to track your rental properties. Whether you're incorporated or just own the properties individually, it's really important to track the performance of how your rentals are doing, or your flip projects. The reason why is a lot of real estate investors are really busy buying their next deal, working on their project and selling it, that they barely have enough time to track all these things. And again, by following tip number 1 and tip number 2, you should be able to easily track your rent and expenses and see how the property is performing. Now you can compare it to the numbers that you originally projected when you started off buying that property. This way you can analyze and see whether you should keep that property or you should sell it. And you can then talk to your accountant to make the best tax decision. Tip number 4. This is something a lot of real estate investors forget to do, and that's track your mileage. A lot of real estate investors forget that they can actually write off the expenses related to them driving around to their various rental properties. However, the CRA will require you to track the difference between personal use and for business use. And usually they'll ask for a mileage log or a log. Who has time to write down every single time they get into their car to go to one of their properties? Well, guess what? We've got smartphones that can track you. So get yourself a mileage app. There's one with QuickBooks that you can integrate to track every time you're going to your rental property. And you can take a picture of your odometer at the start of each year so you can calculate what the total amount of driving you've done for the year and calculate the portion related to your rental versus personal. And then you can claim expenses like fuel, maintenance, and other expenses related to your vehicle. And now that brings me to tip number 5, and I think this is the most important tip of all. Talk to an accountant that's experienced in real estate. If you're a real estate investor looking to actively grow your portfolio, you know things can change from day to day. When you initially buy a project, it might not be the same idea that you have by the end of the project. Where your portfolio goes can constantly change from the growth that you see. Some people might start off thinking they're going to only own one portfolio, and all of a sudden they've got a couple of apartment buildings. And with that kind of cash flow and income coming in, your personal situation can be completely different. So at that time, you can talk to your accountant of whether you should incorporate, keep the properties personally, whether you should depreciate them. Again, talking to your accountant before you buy a property is the best way to have a proper plan in place to save you the most time and money in regards to your taxes. So talk to your accountant so you can be ahead of the curve and not having to pay the most amount of money to the government. I hope you've enjoyed these top 5 tax tips for real estate investors. And if you have any questions, just pop them in the comments below. And if you've enjoyed the video, make sure to hit a like and subscribe. Stay tuned for more videos with myself in Jeff's absence.